That's part of the value investing creed is to try to find things that are unloved, understand them, buy them at a good price, and then wait. And that's the hard part.
They make it sound like it's these unprecedented things, but I think cyclical forces place such a more powerful effect on businesses than we like to admit as investors.
The best way to find good investments is to go the other direction. All right, folks. Well, welcome to Investing for Beginners podcast. Today, Andrew and I are going to talk about this great question I found on Reddit. This is an interesting question, and we thought we would have some fun answering it. There's many parts to it, so bear with us. Here's the first part. So I'm reading Warren Buffett's biography, The Snowball, and it has me thinking about how value investing works. Early in the late 50s, the story goes that Warren would find undervalued companies and simply invest in them. And he'd beat the average market return for a given year by doing so. My question is, how does that work? So let's maybe tackle that part first. So, what are your thoughts on that?
I would say it does still work. It's just a game I've decided not to play. There's a saying by Jim Cramer, who's a very loved guy, depending on what corner of the internet you're in. He says there's always a bear market. Oh, no, I think he says there's always a bull market somewhere.
Hmm.
And so, just like there's always a bull market somewhere, there's always a bear market somewhere. And what can happen with the emotions of the market is people overreact. In my opinion, a lot of times when you're seeing these value opportunities, it's because people are overreacting on the negative side and pricing something to be way worse or way bleaker of a situation than it actually is.
Hmm.
And I think that's a feature of the market that you see today, that you saw a couple years ago, that you've seen 5 years ago, and that you saw in the 50s. It's a hard way to invest because you have to be constantly evaluating. It's definitely a feature that makes the market very, very interesting.
Very, very interesting. And you can just look at the news over the last few weeks to really see some of that narrative impact on investments or companies. All you have to do is look to DeepSeek and everything that kind of happened in a week with that and how much that impacted companies like NVIDIA and TSMC and all the hyperscalers, Google, Microsoft, so on. Then you can segue into the tariff situation and what kind of played out with that and all the reactions to the potential news of what could happen, what didn't happen, but what could happen. And all those things really impact how and what people think about companies. You look back a few years ago at Meta, everybody was very down on Meta, and it's since come roaring back. And Google was supposedly dead because of OpenAI and search and how that was going to die. And that's what a 25% return since that, or something in those ranges. So there is definitely a narrative driven market, especially with the faster we get news and the more we get news, the faster these kinds of things can come and go. And it's not unusual. And as Andrew said, there you can play that game if you want, but it's also you got to be on top of your game, and it's a lot harder game to play for sure to try to take advantages of those drops or overreactions by the market. And I think I don't know this for a fact, but it feels like there's more 20% swings now than there ever used to be. And I don't know if that's a function of the different news cycles or the shortening of news cycles. And you can see it negatively and you can see it positively. To me, it's a much harder game to play. And I, like Andrew, I don't want to play that game and I choose not to play that game just because my sanity wouldn't let me do that. That's too much craziness for me.
Yeah, but I mean, if you're buying a dip or
Mm,
buying a stock that has been dead money for 2, 3 years,
mm,
you could argue you are playing that game.
right.
And it is possible to play our game and double or triple your money in a
Hmm.
decently short period of time. And I'm telling you that because that's what I've done. So
Hmm.
it is a benefit to being a value investor, but to be able to say, oh, I'm going to predict those situations where I know that this is an overreaction, good luck.
Yeah, good luck.
I don't know how you can do that consistently. And that's also why a lot of successful, especially the deeper value you go, a lot of those guys are very diversified because they don't necessarily know exactly which companies are severely distressed for a short period. And so they might spread their bets a little bit more.
Mhm. Yeah, that's entirely right. And the game I choose not to play is the one where I'm just reacting to market news as opposed to understanding the business. And if the Mr. Market says, here's an opportunity on a platter, taking advantage of it like you have. When I think about reacting to, okay, good earnings news came out and the company is down 6% kind of thing. If I don't know the company, it's like, okay, I'm not gonna invest in that particular business because I don't know it. Um, to me, that's much harder game to play.
Mhm.
All right, so let's pick apart the rest of the question. So, a majority of investors don't want or don't know of a particular stock and its price trades below book value. That's the easy part to understand. What I don't understand is that if the stock is generally unpopular, how does its price ever reflect an outsized return? I'm having trouble figuring out how a stock goes from unloved and relatively unwanted to suddenly beating the market. I'm missing the part where people find the stock and suddenly think it's worth buying at a higher price. How does that work?
Yeah, I mean, definitely a good thing to ask. I kind of go back to this idea that the fortunes of businesses can change. We make it sound like it's these unprecedented things, but I think cyclical forces place such a more powerful effect on businesses than we like to admit as investors. We like to all think that we can just buy Coca-Cola and Apple and nothing can ever happen to those businesses to ever affect their earnings or their profitability. But when you're looking at the majority of the market and the majority of businesses, yeah, there are very real things that affect their profitability and also just the natural swings of cyclicality in industries. As an example, supply and demand, that obviously applies to companies that are exposed to the cycles of the economy, but also in the sense that you get supply and demand of the number of businesses that are competing for something. And so high growth is great until it attracts a bunch of competitors who are trying to copy you. And then on the flip side, if you're the only person grinding it through in a business that everybody else has given up on, what do you think's going to happen? Of
Mhm.
course, you're the only one grinding there. Of course, you're going to be a business that emerges from that with better prospects. So, not to say that that's the case for every cyclical downturn or for every stock that's in the gutter, but it happens more than I think we realize because there's a lot of things that cycle and can rebound essentially,
Mhm.
things that kind of snap back and rebound. And I think that can be very powerful. So we get stuck in these time horizons of, oh man, whatever happened in the last 5 years is what this business is going to attain for the rest of its life. And that's totally not the case at all.
Mhm.
A lot of times you find success buying beaten up stocks because you don't know what future development will help the stock grow, but it will happen and you will see that growth because you bought cheap.
Mhm. Yes, you will. And like, what are your thoughts on how does an unloved company go from unloved to popular? Like, what are your thoughts on that?
Well, I guess the home building is a good example because that's one for me personally that I lived through that was very obviously unloved and then became very loved.
Mhm.
And in that case, the I don't know, how would you describe what happened there?
Well, I think a lot of it probably stemmed from prior to the pandemic. There was a lot of negativity around the kind of the home builders, and that maybe there was a glut of homes at the time, and then during the pandemic, for whatever reason, I know a big reason, the rates dropped to all-time lows, and so people were going crazy refinancing homes or selling homes and trying to get new ones, and it created this kind of overhyped demand, I guess is the best way of putting it, because I think people wanted to take advantage of those historically low rates. And then since then, it feels like it's more of a lack of demand, or not a lack of demand, a lack of supply. And that's been pushing up the prices of homes because there's a lot of people that want to buy homes that can't because the rates are decent. but there's not enough homes. And so that's pushing up the prices of homes. So it's kind of a weird place to be, but it shows that even though a company like Pulte is still doing their thing, the not necessarily economics of the business, but the narrative around the business or what people feel like as far as like buying homes, selling homes, it's that changes and that can impact what happens with the business. Not so much that Pulte or DH Horton completely changed what they're doing. They kept doing what they're doing, but the uncontrollable forces around what was happening with them really impacted their business, and the stock is a better way of putting it. It impacted the stock performance, not the actual business performance.
Yeah, I mean their EPS has been insane. So
Mhm.
that's been awesome if you've been a shareholder. Um, Looking just again to companies that I'm familiar with that I can speak to, something like TSMC. We bought that in late 2022, and that was before semiconductors. I mean, semiconductors have kind of always been very popular,
Mhm.
but it hasn't reached this whole AI mania
Mm-mm.
until recently. And then TSMC got, s- um,
Swept it
went
with that.
from $80 a share to 200 a share. It's interesting that for TSMC's case, definitely they've just continued to do what they always do. So before with TSMC, which you see with a lot of foreign stocks, their price to earnings are lower because you have that geopolitical risk
Mm.
or the just this whole foreign thing, like US investors don't want to touch it, the whole China thing, all of that can make stocks in the Asian countries cheaper.
Mm.
And I think for valid reason, like there is in general a lot more geopolitical risk if you're buying in certain areas in the world. But now that you have Nvidia that went to the moon and then Nvidia's valuation went to the moon, is it now that the riskiness of TSMC has become less because compared to Nvidia, well, this is safer.
Mm.
And that's another example of narrative potentially driving up price and creating this huge outperformance. I'll throw another example on here. Dick's Sporting Goods is
Mm.
something I bought in 22, and then that's doubled since. And if you think about the way, I guess, fashion, for lack of a better word, changed from before pandemic to after,
Mm.
athleisure wear has become a lot more acceptable to be worn in public, and a company like Dick's Sporting Goods has benefited from that.
Mhm.
Is that the only reason why the stock is up, from 117 to 240? I don't know. Was it just the price to earnings was low? Was it a combination of, okay, now they have more better earning power because athleisure is worn more than it was or is trendy now? It wasn't simply them executing because they were the number one market leader and they're just widening the gap between them and their competitors. I don't know. I can't say for sure why, but I think it's an example of how the perceived fortunes of a stock or a business can change. And that's where you see these huge swings in price.
Mhm. Yeah, I agree. And I'll throw another log on the fire, kind of the opposite direction. That's Texas Instruments. Like they have struggled a little bit for the last 2 or 3 years because their cycle compared to TSMC and other parts of the semiconductor space have been on an upswing. They have actually been on a downswing. And so they're also spending a lot of money to build out capacity in the hopes that when they catch the wave back up, and it will go back up, that they can take advantage of that by having more capacity to fill the bigger demand that they're expecting. And when you listen to their analyst calls and listen to their capital day, you can hear the enthusiasm in the management, but the analysts that are questioning them are a little more skeptical, and so there's just a little more skepticism around that company than there is against TMC, TSMC, or even Intel, a whole different story. But Broadcom, Qualcomm, some of those other ones, AMD, and so on, those have a much better prognosis according to the market than a company like Texas Instruments. And so it's just kind of interesting how you can see different, even in the same industry, among certain companies, you can see different narratives. Texas Instruments is still doing the same thing they did 2 years ago, but the cycle that they're in is on the downswing. Is it at the bottom yet? Don't know. Will it come out of it? Yes. When? Don't know. And so that's just part of the game. And sometimes you have to wait longer to get the return that you want. But if you believe that the company is executing and doing their thing and nothing has really changed that way, then it's just a matter of riding out the storm, so to speak, and taking advantage of it while you can. And then when it gets to an upswing, then you'll be asking yourself, why didn't I buy more?
Yeah. Oh yeah.
That's always the fun part.
Yeah. I look at a company like Danaher, definitely something where it hasn't seen the growth that it saw, let's say, in the last 5 years or so. But you ask, has anything fundamentally changed? And nothing is super obvious. Danaher, for people don't know, basically sell their picks and shovels to laboratories and things like that. So is it just one of those cases? And I'm completely oversimplifying, but just to have a teaching moment, maybe all the labs bought all this stuff they need and they're good for a while, and then your stuff will start to run out and then you'll need to buy more, right? So you can those type of things, it sounds so simple, but you do see it. We saw it with the semiconductors and the way that the whole automotive shortage during COVID really hit and affected things. So yeah, it's weird. Something that like a company that you wouldn't think would be like that is a company like Apple. If you look at their revenues, they're like flat, 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 boom to the moon, and then flat, 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 boom to the moon. I can't really explain that either, but it's just for whatever reason, supply demand doesn't work in an exact straight line like we all like to think. We think of 10% growth or 11% growth and just think it's going to be this smooth case. I mean, if you're Visa, then sure, or Google, sure.
Right.
Like for the rest of the businesses, this stuff happens in waves, and you can't really predict it. And that's why you have to be holding these stocks for the long term, because if it comes all at once, like it can, then either you have the stock and you get to participate in that, or you don't. If you're constantly chasing these big upswings, then you're constantly already missing it. Like you're already missing the big whatever it is, the big whoosh, whoosh, whatever that is. You're just missing it. And so don't try to chase that, but instead, if you stay disciplined with valuation, you can still have that. I can't tell you how to. It's just buying with a margin of safety allows you to have that. And I don't know. It's something I observed, and maybe it's just because we're living in 2025, or if the market's always been like that, I'm not sure. But yeah, it's just weird how things happen in waves, like tsunamis, not even waves, tsunamis. Yeah.
Tsunamis. Yeah. And I think a lot of that comes back to the mentality of people in the market. And if you're trying to air quote time the market, you're already going to be behind. Because if to your point, if you're trying to catch the wave as a surfer would, not that I'm a surfer, but if you're trying to catch the wave and you don't time it correctly, you're going to miss. And you may get some of it, but you won't get all of it. And if you're constantly trying to do that, that's a really, really hard place to be. And studies have shown that if you own great companies for long periods of time and you buy them at a good price, you're going to do well. And doesn't mean that it's always going to go up to the right. You're going to have periods where companies or industry sectors are going to struggle. And Buffett and Munger have both talked about, I think, at least 2 or 3 50% drawdowns in Berkshire in the time that they've been with the company. And so that's 50, 60 years. So having the fortitude to handle, I mean, that's their investment, that's their business, that's their livelihood. That's a little different than us, but not a lot. Being able to withstand those, takes a lot of fortitude and a lot of understanding what it is that you own. Sometimes a company like Visa will drop, and it's not necessarily because they're not performing, it's because other factors in the economy, the sector, maybe market sentiment, a pandemic. There's lots of things that can cause companies to drop for unwanted reasons. But the trick is to really understand what it is that you own. Again, it comes back to understanding what you're doing. If you understand that you're buying and selling companies as a owner of a business, that's a different than trying to understand and own a ticker or a symbol on your phone. That's a different mentality. And when you think about it the way that we try to think about it and try to teach, and the people that we enjoy and have learned from do the same, that's a different mindset and it's a different mentality. And that's how you can find companies that are unloved. And that's part of the value investing creed, is to try to find things that are unloved, understand them, buy them at a good price, and then wait. And that's the hard part, right? We all want to do stuff. We want to do things. We feel like if we're not doing something, that we're not being active and we're not participating in the growth of a particular company. And it's hard to let Satya Nadella do all the heavy lifting for Microsoft and for us not to do anything. But ideally, that's what you want to do, is buy it and let him do all the heavy lifting. And you just sit back and enjoy the fruits of his labor.
To help you grow as an investor, I'd say probably our free ebook and email series at stockmarketpdf.com.
All right. So let's maybe tackle the last part of the question. So I'm not understanding where the new popularity of a company comes from, especially over the short term, to beat the market in years early in Buffett's career. Same thing for cigar butt stocks. Where does the last puff come from?
Yeah. And, you know, I'm just going to say it. I think that's a bit of myopic thinking. We all, because I've done it too, we all think that everybody thinks like we do. We all think that everybody's trying to find Buffett type stocks or high growth stocks or big compounder stocks. And that's not the case. The market has so many different people, so many different investing timelines, so many different temperaments, risk appetites, career goals, even all of these things. Even you go down the path of like pension funds and hedge funds and needing to smooth out their returns because they have investors withdrawing and all of these things. And so you will see stocks like I mentioned, Dick's Sporting Goods or Taiwan Semi, who will have either narrative or real life business changes. But you also just have little small things too that can change certain subsets of traders or investors that affect the stock price. So a unloved stock that a Warren Buffett or a Chuck Ackery would never touch can still go up in price. Shocker. You know, like just because we have these particular rules for ourselves or ways that we do things, it's very easy to get in this myopic circle that we think so many other people invest and look at a stock the exact same way that we do. And that's just not the case whatsoever. And so I think this is a little bit of black and white thinking, like a stock is unloved and then it's loved, or, you know, and as if there's just that switch and there's nothing in between. When in fact, a company can go from, let's say, everybody thought it was going to grow at 3% a year, and now everybody thinks it's going to grow 5% a year. And that could double, triple the stock. But maybe that's still not the type of stock you want to own because you don't want to compound at 5% a year. So just to use as an example that you can see that, and I think it plays out a lot in the stock market. And if you kind of have more of an open mind and an open viewpoint to the different types of businesses and just the wide range of outcomes that there are, both in valuation and in just the businesses themselves, I think that helps understand why you see these huge swings and why there's these last puffs, as the person put it.
Yeah, I totally agree with that. I think a lot of times that we can be an amalgamation of the people that we surround ourselves with. And in today's age, if you think about the echo chambers that we can all experience in a social media environment, for example, and I spend a fair amount of time on FinTwit, and there are different narratives that go on in that world depending on who is showing up in my timeline. And I'll give you a couple examples. A few years ago, or maybe even a year ago, a company called Celsius was all the rage. Everybody was talking about it. I wasn't, because I don't know the company and never learned about it, and not my thing. But there are a lot of people talking about the company all the time, and the company has seen a downturn in fortunes. I don't know exactly why. Again, I don't follow the company, but now you can't go on FinTwit and find it. You have to search to find somebody talking about it. Whereas maybe 6 months to a year ago, every third post was about the company. Now everybody's talking about Palantir or HIMS, and that's what everybody's talking about. And so if you're in that echo chamber, you think that that's all that really exists is those companies and what's going on with those businesses. But there's a wide range of companies out there that nobody knows about, nobody hears about, that have fabulous returns. Uh, Andrew talked a while ago about WD-40 and what a great company it was and what a great returns it had. And I don't think any of us in the investing world, I had never heard anything about it until Andrew brought it to my attention. I was like, what? So I think it just showcases that the popularity can come and go, and it really can depend on the echo chamber that you're in, especially now in this day and age of social media. And one of the ways to combat that is try to make sure that you widen your echo chamber as much as you can, and try to listen to as many opposite voices that you may not normally listen to help give you a more balanced opinion or thought on things. Because if you surround yourself with 10 like-minded people that are all talking about a particular company, let's say it's American Express, great business, great investment, love the company, but let's just say everybody's talking about American Express, you may not even think about Visa and MasterCard because it just doesn't even enter your circle of knowledge, because everybody's talking about this one particular company. And that doesn't mean that those other companies couldn't provide you with a good return, but you just have to be aware of where the echo chamber is and how much that can impact the short-term results of different companies and whatnot. And that's one of the things that I admire about Buffett. Because he wasn't in New York, he removed himself from that echo chamber. And so his echo chamber was he and Charlie, or any friends that he had. And he read a lot. And he would ignore companies, he would pick different companies and whatnot. His investing style has changed certainly over the years, but the foundation of what he does has not really adjusted much. And so I think when you're trying to find investments or looking for investments, kind of be aware of what kind of investor you want to be, where you are in your evolution, if you will, and try to make sure that you're not listening to the echo chamber. One of the things about value investing is the best way to find good investments is to go the other direction. So if everybody's talking about Palantir, for example, you can go another direction. And always remember, you don't have to invest in what everybody else is investing to get a good return. I have come across plenty of companies. We talked about WD-40. I think I mentioned Cheniere Energy a while back. For the last 5 years, a 30% return. I had no idea, never heard of it. Nobody talks about it. Just shocked the heck out of me. So there's lots of great opportunities out there. You just have to keep an open mind and make sure you keep your eyes open and look as much as you can.
Yeah, and I think investors, just as a general overview, broad brush, paint things saying that the past is going to be whatever happened in the past is what's going to happen in the future. And how I feel about a stock is what has happened in the past. And that's a big lie too.
Mhm.
It's so much easier to look at the numbers of a stock and get excited and then start drawing up narratives than it is to actually like try to find narratives that are unbiased. Like you'll always find the greatest stories with the stocks that have done the best.
Mm.
And then once they become dead money, then all of a sudden the happy stories go away. Well,
Mm.
shocker.
Yeah.
So you have to be very careful because and that can be it could be a great business too. It could be a business that has like a Nvidia type business that 10x their operating income or something.
Mhm.
The stories will be there whether the stock price follows it or not. But notice how the stories change if the numbers start going in the other direction. All of those stories are always there.
Mhm.
A company has lots of stories, positive and negative.
Mhm.
You'll just see the negative ones reach the surface in the echo chamber when the stock or the business is stumbling. You'll see all the positives rise in the echo chamber when the stock's killing it and the company is growing like a weed. So just be careful with that too. I think the rear view mirror syndrome is very strong when it comes to how people feel about businesses.
Mhm. Is there a name for that bias?
Is
That
it hindsight? I mean,
Yeah, probably. Yeah, that's
kind
what I
of. I
do.
mean, hindsight bias is like, oh, yeah. I look at hindsight bias a little bit differently, but that could be the actual
Mm.
definition. I don't know.
Yeah. Yeah, I agree. I think that's a really good explanation.
Yeah. Well, that will wrap up our show. We hope you found it helpful. You can reach out to us at any time, newsletter at einvestingforbeginners.com. Connect, learn, and grow with Value Spotlight. Peace.